Recently, a major semiconductor company in Singapore unexpectedly pulled out of China, and another large factory in Shenzhen suddenly shut down. On August 11th, ASMPT, a global leader in semiconductor packaging and testing equipment, announced the liquidation of its subsidiary, Advanced Semiconductor Equipment Shenzhen Company Limited, abbreviated AEC, which is based in Bao'an, Shenzhen. It also announced the closure of its factory. Nearly 1,000 employees were left facing unemployment within 3 days, sparking protests. The day after ASMPT's announcement, a large group of employees gathered, demanding the union explain the legality of the layoffs. One worker loudly questioned, "Why did the company terminate our contracts? What did we do wrong?" The union representative simply responded, "The company is closing as part of normal business operations," promising to relay their concerns but failing to provide any legal justification. In a video taken at the scene, dozens of employees gathered in a meeting room, expressing their dissatisfaction and asking, "Did the company just fire us suddenly?" Many employees expressed concerns about insufficient compensation and questioned whether the company was avoiding its social responsibilities. ASMPT responded by saying that the closure was not due to company losses, but part of a global capacity and supply chain optimization. The company plans to focus resources on Singapore, Germany, and Huizhou in the future. However, financial reports show that by the end of 2024, the company expects net income of around 20 million yuan and net assets about 444 million yuan. The closure will incur restructuring costs of approximately 360 million yuan, including severance pay and lease losses. ASMPT is one of the world's largest suppliers of machinery and materials for the semiconductor and electronics industries, specializing in the development, production, and sale of semiconductor wafer assembly and packaging equipment. In China, ASMPT's equipment is widely used in chip manufacturing and packaging plants and is an integral part of the Chinese semiconductor industry chain. ASMPT's Shenzhen factory was established in 2019 and reached a peak of 1,300 employees. Its closure after just 6 years has shocked many in the industry. This factory shutdown has also prompted a re-evaluation of Shenzhen's business environment. Mr. Liu, a former volunteer at the Shenzhen Labor Service Center, pointed out that nearly every day in Guangdong, companies are shutting down or laying off workers. Many of these companies are not failing due to losses, but rather a lack of confidence in the Chinese market's future. He said, "These companies have sensed the risks and are pulling out early. In the past month, I've received many inquiries and requests for help. Most of the companies that shut down weren't struggling in terms of business performance. Maybe these big companies sensed something, and that's why they made such a decision. Many workers are now in difficult situations." Since the late 2010s, the Chinese government has enforced a mandatory social insurance policy, requiring companies to pay full social insurance for their employees, which has continued to increase the pressure on foreign businesses operating in China. Mr. Liu also mentioned that labor and operating costs in Shenzhen are much higher than in surrounding cities. Employee salaries are 20 to 30% higher than in Huizhou, and factory rents are 2 to 3 times higher. With the added burden of mandatory social insurance policies, foreign enterprises have been enduring heavy cost pressures for a long time. An investment consultant who has worked for foreign enterprises in Shenzhen for years also believes that while ASMPT was profitable last year, Chinese orders dropped sharply this year, and the company expects to incur losses in the future, which led to its decision to withdraw. Since July this year, many foreign and private enterprises in China have been closing factories, resulting in widespread unemployment and highlighting the difficulties faced by both companies and workers. Mr. Chen, who has been involved in foreign trade in Guangdong for 20 years, stated that the departure of foreign enterprises is driven by policy and environmental pressures. He said, "Foreign enterprises are leaving because of policy and cost pressures, while workers are losing their jobs without warning. The government has not responded. Both companies and workers have become victims of the system." A retired professor from the School of Management at China University of Science and Technology told reporters that many policies from the Chinese Communist Party have deviated from a market-oriented approach. Foreign enterprises can relocate to other countries, but domestic private enterprises have nowhere to go. Institutional factors are the key. Industry analysts generally agree that ASMPT's case is not an isolated incident, but a reflection of the deteriorating operating environment for foreign enterprises in China. In the past 2 months, several foreign and private enterprises in Guangdong have closed factories or laid off workers, leading to mass unemployment. Many workers have been forced to switch to lower-level industries like logistics and express delivery, seeing a sharp reduction in income. ASMPT holds a 38% market share in China. Ms. Chen, a semiconductor analyst from Jiangsu, remarked, ASMPT's withdrawal from Shenzhen sends a signal to the industry. The overall environment is harsh, and private enterprises are struggling. The closure of ASMPT's factory reflects the dual crisis faced by both Chinese enterprises and workers. Foreign companies are choosing to leave due to policy and cost pressures, while workers are losing their jobs without warning. Some have received compensation, but are uncertain about the future. Foreign enterprises can relocate, but domestic private ones are finding it harder to cope. Ms. Chen warned that ASMPT's sudden closure could be just the beginning of a broader pullback by foreign enterprises. She said, if policies and the business environment do not improve, similar events will only increase in the future. ASMPT's unexpected departure from China has unintentionally shifted attention to Singapore, and it's surprising for many. A lot of people might not guess who the largest foreign investment source for China is, considering it's the world's second-largest economy. Is it the US, the EU, or Japan? The answer is none of the above. According to official Chinese statistics, Singapore has been the largest source of new foreign investment in China since 2013, and in April 2022, it even surpassed Japan to become China's largest cumulative foreign investor. Many big brands deeply rooted in China actually originate from Singapore, which has led many Chinese people to mistakenly believe that they're domestic brands. So, what industries in China have attracted the most investment from Singapore, and which brands are from Singapore? Let's take a closer look. First, real estate malls. In Chongqing, you might be familiar with the Jinsha Tower in Chongqing. This is Raffles City, built by the Singaporean company Capital Land. Raffles City is already a famous shopping mall complex in Singapore, and in China, there are 9 Raffles City locations. They can be found in cities such as Shanghai, Beijing, Ningbo, Hangzhou, and Suzhou. Each Raffles City has become a landmark building in its respective city. In addition to Raffles City, Capital Land also operates shopping malls under the name Capital Mall, the hotel brand Ascot, and has expanded into the development of industrial parks, residential areas, and data centers. Capital Land manages or owns over 200 projects in more than 40 cities in China, with an asset management scale of approximately 270 billion RMB, making it one of the largest real estate groups in Asia. Second, the food sector. Wilmar International holds 40% of China's cooking oil market share. Wilmar International was founded in 1991 by Malaysia's richest man, Robert Kwok, along with his nephew, Kwok Kun Hong, and Indonesian palm oil king Matua Satoris. The company is headquartered in Singapore and is one of the largest publicly listed companies on the Singapore Exchange by market capitalization. The company's business includes palm oil planting, oilseed pressing, cooking oil refining, flour, and rice processing, making it the largest agricultural group in Asia. Yihai Carry, a subsidiary of Wilmar International, is responsible for expanding the brand in China. At the time, Robert Kwok helped China resolve its sugar supply issues and made around $4 to $5 million in foreign exchange profits through futures trading, earning China's high regard. The Kwok family's entry into China was strongly supported by the government. The brand that quickly helped the Kwok family establish a presence in China was the now famous edible oil brand Golden Dragonfish. In addition, the Kwok family also operates the Shangri-La Hotel brand in China, currently led by their daughter as chairman. Shangri-La was also a brand established by Robert Kwok in Singapore. In 1983, Robert Kwok opened the first Shangri-La Hotel in Beijing and rapidly expanded to other cities such as Hangzhou, Shanghai, Xi'an, and Shenzhen. Third, the capital industry. Temasek Holdings is Singapore's sovereign wealth fund and has publicly stated more than once that China is the best performing market. Over the past 10 years, Temasek has heavily invested in China, making it the largest market in its investment portfolio. Temasek entered China in 2004 and set up an office in Beijing. The key figure behind this decision was Ho Qing, wife of Singapore's former Prime Minister Lee Hsien Loong. When Ho Ching took office, her first step was to focus on China. Temasek's investment direction was aligned with China's economic trajectory and can be divided into 3 phases. The first phase was during financial reforms, when Temasek focused on investments on traditional industries like banking, non-bank financials, and real estate, capitalizing on significant reform dividends. For example, it became a shareholder in CITIC Securities, China Ping An, New China Life Insurance, and Industrial Commercial Bank of China. The second phase was during the explosive growth of China's internet industry in 2010, coupled with a risk-hedging demand driven by the European debt crisis. Temasek shifted its investment focus towards emerging trends driven by consumption, investing in the internet economy, e-commerce, and non-bank financial services. Alibaba, Tencent, Xiaomi, and other internet giants' rise can be partially linked to Temasek's early investments. In the third phase, Temasek concentrated on digital transformation, the green economy, and new consumption trends. In 2021, Temasek frequently made investments in China's logistics and warehousing sectors, backing a series of companies such as JD Logistics and YY Logistics. However, subsequent tightening of regulations severely impacted China's capital markets, resulting in worsening investment performance and a decreasing share of Temasek's portfolio in China. By 2024, China's market accounted for 13% of Temasek's investment portfolio. The fourth sector is commodities. Trafigura is a name many might not recognize. It's not a B2C company directly facing consumers, but the resources it controls have a profound impact on our lives. It's the world's second largest independent non-ferrous metals and concentrate trading company, and the third largest independent oil trading company. Oils, metals, and other commodities are all under the control of this company. Whether it's daily travel, plastic products, or high-end manufacturing industries, including the electric vehicle sector, all depend on its supply chain. It is currently the largest independent commodity trading company in China and the largest supplier of copper, lead, and zinc concentrates in the country. Trafigura has 7 subsidiaries and offices in China. Surprisingly, this company also originates from Singapore. Fifth, the semiconductor industry. This is the least notable, but an important and steadily growing sector for Singapore and China in recent years. According to data from China Customs quoted by Nikkei Asia, China's imports of semiconductor manufacturing equipment reached a record high in 2024, totaling over $30 billion. Among these imports, Japan and the Netherlands supplied $9.6 billion and $9.5 billion respectively, while Singapore contributed almost $4.9 billion, a 345% increase from 2018. This makes Singapore the third largest source of semiconductor equipment imports for China, surpassing the United States, which provided almost $3.2 billion. In recent years, Singapore has attracted semiconductor companies from all over the world to set up offices there, and chip equipment suppliers use Singapore as an export base. Foreign companies operating in Singapore include Japanese firms such as Advantest, Dutch companies like ASML, and ST Microelectronics from Italy. As mentioned at the start of the program, ASMPT plays a critical role in China as a semiconductor equipment supplier, particularly in the field of chip packaging and assembly. It is one of Singapore's most important semiconductor companies in China. The economic relationship between Singapore and China is much closer than many people realize. Singapore's surge in semiconductor manufacturing equipment exports to China is largely due to the U.S. government's ban on high-tech products to China. There's been growing skepticism about Singapore's role as a backdoor for smuggling advanced chip manufacturing equipment into China in recent years. Especially since Trump's return to the White House, the U.S. has been tightening its controls on exports of advanced chips and manufacturing equipment to China. Singapore's balancing role between the U.S. and China has been undergoing subtle changes. On February 28 this year, Singapore filed charges against 3 men suspected of selling high-end AI chips from U.S. tech giant NVIDIA to Chinese companies. 2 of the men were Singaporean citizens, and 1 was Chinese. Singapore's Foreign Minister Vivian Balakrishnan vowed to strengthen multilateral export control systems, stating that Singapore would not tolerate tax evasion, fraud, or false declarations. Singapore's actions are seen as a tough choice between the U.S. and China. Despite its proximity to China and significant business interests there, Singapore cannot sacrifice its relationships with the West and its freedoms for economic benefits in China, especially as these benefits are becoming increasingly uncertain. Moreover, in the increasingly tense Taiwan Strait situation, Singapore suddenly found itself under unprecedented scrutiny. On August 8th, Taiwanese media reported that in a simulation held in Singapore, where China's military was hypothesized to pose a sea and air blockade on Taiwan, Southeast Asian countries tried to evacuate the 1 million people stranded in Taiwan. They ultimately realized that Singapore's airlift assistance was crucial for evacuating their citizens. According to 4 people familiar with the matter, in April this year, about 40 participants and observers gathered at the Easton Hotel in Singapore, including current and retired officials and military officers from the Asia-Pacific region, as well as security scholars. Over a 2-day war game, they simulated crisis response actions. As time ticked away, some participants considered coordinated action through the Association of Southeast Asian Nations, also known as ASEAN, while others contacted representatives from the simulated US, China, and Japan to discuss opening special air and sea corridors to evacuate foreign nationals. Sources said that the most apparent conclusion that emerged was that Southeast Asian countries needed Singapore's airlift capabilities to evacuate their citizens. One participant said, until Singapore intervened at the last minute, there was no progress at all. They eventually found a way to evacuate their own people and suggested evacuating others as well. The participant added that Singapore has quickly deployed and trained forces in Taiwan for decades, enabling it to leverage airports and planes. 3 sources disclosed that until the war game ended, there was no discussion about how Singapore would negotiate with Chinese authorities to ensure the evacuation routes or how the evacuation would be carried out in detail. The International Institute for Strategic Studies, which organized the simulation, told Reuters that participants attended in a private capacity, and the institute was unable to comment on the content of discussions, attendees, or any other matters. Drew Thompson, a security scholar at the S. Rajaratnam School of International Studies in Singapore, who did not participate in the simulation, said that Southeast Asian countries must establish meaningful, unofficial relationships with Taiwan, particularly with Taiwan's military, beyond the war games and emergency event discussions. Drew Thompson said, "The big takeaway here is that a plan is one thing, but you need the access and the relationships to put it into play." From the information stated, it's clear that once the Taiwan Strait crisis truly erupts, Singapore's position will become incredibly sensitive and important. Singapore seems to be cautiously revealing its stance on assisting Taiwan, while maintaining a seemingly neutral identity. In the context of the Philippines' tense standoff with the Chinese Communist Party, Singapore undoubtedly views the Philippines as a reliable partner. Analysts pointed out that in April this year, Ho Ching, wife of Singapore's former prime minister and the controlling figure of Temasek, directly referred to Xi Jinping as acting like a gangster boss during his 12 years in power. Her sharp remarks shocked many. This is significant because Ho Ching has very close ties to the CCP's top elites and is well aware of the current political and economic situation in China. Her outspoken comments not only reflect disdain for Xi Jinping, but also seem to be a prediction regarding the future investment prospects of her family's capital. Based on her remarks, Temasek is likely to completely withdraw from the Chinese market in the coming years. The sudden pullout of ASMPT from its profitable Shenzhen factory, despite the company's success, reflects not only the company's pessimism about China, but also indicates an early bet in the ultimate struggle between the US and China. In the semiconductor industry, ASMPT likely sees no chance of success for the CCP, and without hesitation, it has joined the ranks of those aiming to block the CCP.